113.
600.
And over here we have how much?
80,200.
And here too. 1, 2, 3. All right, so add it up. Let's see it balance.
Tax balance.
33,400.
So give us the figures, please, again. Here is how much?
33,400.
33,400. And it balance 113,600. Yeah, I have some messages in the chat box. Please, the stated capital, we are not going to add the share for shares into it. Yes, we are not. Because of this statement. Because of this statement, where is it? Picant has recorded the share for share exchange. So it has recorded it. And even this one too, they did it. Okay. Because they have recorded it, you don't need to double record. We saw that it was already in the statement of financial position. We just picked them and we posted them. Please ask questions though. All right. You can start reading this one. So you have it at your various places. We are looking at the question 3 now. And that is the question we will close with. It's also a question that I've decided to give you to, it entails quite a lot so that to help you in your understanding. So take your time and read at wherever you are. I'm giving you the next 8 minutes. So at exactly 7:40, we'll commence the computation. So read it at wherever you are. You have it with you on your phone, wherever. Make your notes. We'll come together and do it. Guys, let's begin. So group structure. I'm sure by this time you have done it. So let's roll. So we have Panda, who is buying who? Salvia, right? And they are doing 80% on April 2009. Please, let's go and check the requirement of what we are supposed to do. We are supposed to calculate goodwill. Okay. And we are supposed to calculate the carrying amount of investment in Ambra. So the Ambra is the associate, right? Then we are supposed to do consolidated income statements. Okay, so this one, there's no balance sheet. But because they said we should calculate goodwill, meaning that we still need to do our workings too to get the subsidiary at acquisition date, all right? So please. So Salvia on April 1, 2009. And per the requirement we saw here, the financial year ends September 2009. So that one means how many months? The full year? So no, it won't be.
6 months.
6 months. This is P&L. So I mean, the only major things that happen normally in your P&L is your sales, your cost of sales. All right. So unless there are dividends paid from the associates or whatever it is. So let's move on and see what will happen. All right. So let's read the question. 80% of the equity in Savia, the acquisition was through a share-for-share exchange. So Michael, please do the share-for-share exchange for us. You'll be the one to give it to us. All right, do that. Share-for-share exchange of 3 shares in Panda for every 5 in Salvia. So Michael, I'm waiting on you. You can put it in the chat box. All right. The market prices of Panda and Salvia are this 6 and 3.2. Okay, just like the one we did. Now on that same day, which is this same day, Panda acquired 40% of the equity of Ambra at 2 cedis. The summary financial statement for the 3 companies are what you see. So we have revenue, cost of sales, gross profit, distribution cost, admin, investment income, which is interest and dividend. Right, that's great. Finance costs. So we have finance costs. This finance cost, we need to check it if it is interest, because intra-group interest is cancelled. All right. Then profit or loss, we have income, tax. This one is, all right, this is what we have. Profit and loss is given for the year. We have them. Equity shares, 1 Ghana cedis. Premium, this is what we have. Does that mean that they said the premium was recorded? Oh, well, we are not doing SOFP, so we are not interested. Profit or loss for the year ended is also given as this. Dividends paid also here, which will be interested because you are doing P&L. And normal, the fair value of the net assets of Savia at the date of acquisition were equal to their carrying amount, with the exception of an item of plant, which are the carrying amount of 12 million and the fair value of, so the fair value exceeds the carrying amount. So this is a revaluation surplus. You see, every day you'll be getting surplus. You get, by the time you get to your exams, it will be an impairment. Michael, you said share EC. I don't get you. Please, what I want you to do is to do the share for share exchange. Get us the value. All right. They said that the plant had a remaining useful life of 5 years, straight line depreciation at the date of acquisition of Salvia. All depreciation are to be charged to cost of sales. This is policy. All right, IS 8 policy. All right. In addition to Salvia, Salvia owns the registration of a popular internet domain. The registration, which had a negligible cost. All right. And they said has a 5-year remaining useful life at the date of acquisition. All right. However, it is renewable indefinitely at a nominal cost. At the date of acquisition, the domain was valued by a specialist at 20,000. 20,000. And they told us that it has 5 years. But they also told us that it has negligible cost. Okay, you'll see how you do those things when we get to our two. I have a message in the chat box. Okay. We will get to see when we get there, but I think the fact that you've been able to code this one alone, I'm fine. This is it. This part alone makes me fine. Thank you, Michael. All right. Then what else? So at the date of acquisition, the domain had this. All right. So fine. Then we move on. It says that the fair value of plants, the fair values of the plant and domain has not been reflected in Salvia's financial statement. No fair value adjustments were required on the acquisition for Ambra, right? That is the associate. Immediately after the acquisition, Panda invested 50 million, 8% loan note from Salvia. All interest accruing to September had been accounted for both by both companies. Okay, that is interesting. Salvia has other loans in issue. Okay, that one makes the finance cost that is over here very serious. We will deal with that. It's dangerous. But as for those of you who have the manual, the book, I think you should be able to deal with that. Aside that, Panda has credited the whole dividends received from Salvia in the whole of the dividends it received from Salvia in investment income. Okay. Then after acquisition, Panda sold goods 50 million, on which he made a profit of 20%. Salvia has had 1/3 of those goods also over there. Okay, so that is that. There is no intra-group current account. Even if there is, we are not doing SOF. We are doing balance sheet, P&L. So the NCL interest in Salvia is to value at full fair value at the date of acquisition. The proposed Salvia share price at that date is taken to be the indicative. So Michael, this one too, I think you asked a question about it. You should be able to do that one also for us by the time we get there. The goodwill of Salvia has not suffered impairment. However, due to losses, the value of Panda's investment in Ambra has suffered impairment. Okay, so impairment in the associate. This one is a standing 10. Then we are now good to go. All right. So workings 2. I think we need to do Ambra. So that one too is on the same date. So 6 months. And how much did they purchase? 40%. All right, workings 2. Something we need to do. Who wants to guide us to that? Yes, please, anybody who wants to guide us to that? Adama Brebra. Okay, let's start with stated capital. Just a minute, I need to check something. Yes, I'm back. So stated capital is how much? Let's go and see. So, all right. Okay. Then retained earnings. What is the retained earnings? The first one you always need to pay is at reporting. Or where are you at reporting? So this is the one they have for retained earnings up to 2008. Then this is the one for the year. So at reporting will be this one plus this. So 173. Let me advise you. In any question that you will see that it is like this, they want you to be very, very careful with your at acquisition retained earnings. You see, we've been dealing with questions and you should be following suit. As for your at reporting, it's not difficult to get it. So this one. Normally, you see this one is at October 2008, but the acquisition was not in October 2008. So if it was in October 2008, this one would have been our at acquisition. But you see, there are changes. But normally when they do that, they want you to get this part first for you to be able to come to this part. And because they give you the P&L separately. All right, so now let's look at the P&L. Now, I told you that, see, they've told us that there is an interest over here. Interest is here. They issued immediately. So it means that the post-acquisition profit has interest in it between the two groups, the two companies in the group. And we all know that intra-group loans are cancelled off, just as the interest too are cancelled off. So please, that loan, he said immediately after acquisition. So immediately after acquisition tells us that there is an interest of, he said 8% of the 50 million. Bear in mind, they did it 6 months. So please start punching your calculators, everyone. Let's get involved and finish this question. Yes, how much will you get for that? Please, how much? Hey, are you guys tired? Should we postpone this thing to tomorrow?
No.
Get me the figures, please.
I got 2,000. I don't know if it's correct.
Oh, this is mathematics.
Mm.
Yes, 2,000.
2,000.
All right.
Yeah.
Now, so they have this 2,000, and they are telling you that all interest accruing has been accounted for by both companies. So it means that the interest that is here, they've accounted for those things inside. But we all know that the post-acquisition money, so normally, in a normal circumstance, we should pick this figure and divide by 2. So that we will know, divide by 2 because it's 6 months, so that we will know that that is the post-acquisition, and so we can derive here. But unfortunately for us, there is inside that profit over here, this 2,000, the post-acquisition. According to that note, they said they've recorded it before deriving over coming here. So it means that before we can split this figure into 2, we need to add back this thing, the 2,000 they deducted here. Of course, the question told us that they have other loans on which they will also pay interest. So the 3,000, 2,000 is between them, and the 1,000 will be the other loan. But you see, if we pick this one and we divide by 2 and put half here and add half to this one and put here, we will be making a mistake because intra-group interest should be cancelled first. So those of you, I think I've explained this thing time and time in class. So this 21,000, you need to add back the 2,000, and that gives you 23,000 before you split it into 2. Now, once you split it into 2, you get how much? 11.5, right? Over here, and another 11.5 over here. What did I say? What did I say? It will skew it. Okay, it will always skew it. Once you are done with this, at the end of the day, you should still end up at this. So the skewing is that in this post-acquisition, you will take off the 2 million, and therefore you get what? 9.5, and here will be what? 11.5. At the end of the day, you are still having what? Your 21,000. Please be careful in these circumstances. I know sometimes when they want to, this thing that you are doing, if you miss this, your goodwill is wrong. Your I mean, your good old 6 months that you are looking for is wrong all of a sudden. And that is what happens. So you need to be very, very careful. So it means that this is how, and I think I've explained this thing in class for you people. So you add it back, you share the two, then you come and less it, that one from the post acquisition, because the post acquisition own should not exist. Okay. So that is how you skew it at the end of the day. So you realize that it is the same 21,000, but you are not just picking this 21,000 and divide by 2. All right, you will skew it because the intra-group loan after the post acquisition should not exist with its interest. How can you give a loan to yourself and say you are making interest out of it? It shouldn't happen. So you realize that here, what you end up having is 9,500. And over here, you have what? 11,500, which you are going to add to your this one. So you realize that this is it, October 2008, but you purchased the thing in what? April 2009. So the part half, 152, makes your, so I think this one is what? 163,500. That is how you get your retained earnings at acquisition. Please, any question? Any question? Of course, I've explained these things in the video, and if you see, when you are watching my lecture videos, don't skip and don't make it boring. Pay attention as if you are sitting in class and you are having a video. And make notes. It is not something you sit in your Trotsky and you watch. No, no, no. You sit down and you watch. Any question? All right. In the absence of any question, we can move on. Let's come to our fair value adjustment. What is the fair value adjustment? How much is it?
$70 million.
Hey, are you sure? Read the question well. I think tiredness has set in. That's the meaning.
Is the difference?
And how much is the difference?
5,000.
5 million.
All right. What about fair value adjustment depreciation?
It was 100.
It's how much? 5 years. So you do 5,000 over what? 5 years by 6/12, please. This thing, you people keep missing it. So